They're excellent as always. Let's bring in our first guest this hour. Malcolm Ethridge is Executive Vice President, also Financial Advisor at CIC Wealth. $750 million, that's with an M in assets under management, AUM as at last count. Also a CNBC contributor. He joins us now live. Mel, good to see you.
Hi, Malcolm.
So let's get to the July CPI print first. What was it that, the numbers came in milder than expected. Initially, the market liked it. Then it had second thoughts. What happened?
Yeah, essentially, we were trying to digest whether it was good news or bad news. And I have to imagine most investors were focused on that core CPI number and not just the overall number. And so as we continue to parse out things like energy, foodstuffs, maybe housing, owner equivalent rents, it starts to become a little bit more obvious that maybe it's not as foregone a conclusion as we hoped, that September is going to mean another pause and probably the end of the rate hiking cycle. And so I imagine the rest of August will look similarly as we go sideways into September's FOMC meeting to find out exactly where we're going to stand.
All right, so it might not be done just yet with the Fed, or the Fed rather might not be just done, and September could be live. And the thing I noticed, Mal, is when you track the series going back to the peak inflation back in June of 2022, when it was not in excess of 9%, was it 9.1 or 9.2? It's come down a heck of a long way, right? But this was the first uptick up to 3.2 that we've had since that peak back in June. So there's probably something to that September could be live. How are the market's going to react then for the rest of this year if September is still live and the Fed is not done yet?
Yeah, I believe Jerome Powell and his crew. Well, I guess I should say Jerome Powell specifically, because some of the Fed governors have come out and openly dissented. But I believe Jerome Powell when he says that he's committed to staying data dependent and actually making the determination of what needs to happen with rates point to point. And so I would imagine that slight uptick was the little bit of heartburn that he needed to say, hey, we do not need to get too far over our skis and get too excited and start popping champagne just yet. There's obviously some stickiness to this last little bit of inflation. It's sort of like anyone who's ever tried to lose meaningful weight before. That first 20, 25 pounds is the easiest to lose. It's that last 5 pounds that's going to take some real work to get gone. And if you're not careful and you revert back to some of the old stuff, that's where you start to see those upticks on the scale. And so I think similarly in this case, that little blip is enough to tell Jerome Powell, the job is not done. We can't ease off. And I think that's where we'll see the market be a little bit disappointed come September, if and when that rate hike that I'm expecting actually does happen.
Yeah, those last 5 pounds, that's when you've got to do the 30 press-ups on your knuckles, right? When you look at the valuation in this market, Malcolm, it's trading at a forward earnings multiple of 20 for the S&P. The bond volatility is back. We could have a re-acceleration of inflation on our hands as well. Does that imply, in your mind, a 10 to 12% pullback? And if that does materialize, would you be a buyer of that dip?
Well, I don't know about a 10 to 12% pullback necessarily, but what I do know is we haven't had a 5% pullback in the market since March, right? In the stock market specifically. And usually we get 4 to 5 of those on an annual basis. And then usually when the market does pull back 5% or more, it continues past that 10% breaker point. So we may see a 10 or 12 like you're asking, but I know we're at least due for a 5% pullback in the near term here because it's been so long since we've actually seen one. So to your second question, would I be a buyer there? I actually think this is a place where investors could and should be planning to pick their spots. I definitely think, we've been saying for the last, decade, maybe folks in this business have been saying that it's a stock picker's market. Most of the time we've been dead wrong, right? You could have bought the S&P and made out just fine. I do believe that we are finally in what we consider to be a stock picker's market, where it's not obvious where the winners are until it all shakes out by the end of the year. And so I do think that there's going to be some really great opportunities to go in and start buying some names that you've had on your watch list for however long, and you've been just waiting on your perfect opportunity. I definitely think that's coming.
All right, I hear you, Mel. So, we're not really going to know until the dust clears. But what's your sense, or what's your best bet? Where are the opportunities going to be?
So I'm definitely a fan of tech. That's no surprise to anybody who's ever heard me on the network before. But specifically, I think that the opportunities in tech are not necessarily the AI wave that we've all been wanting to talk about for the last however many months, call it the last 6 months maybe. I know that the AI excitement has tamped down just a little bit, but I really think the opportunity in tech is going to come in cybersecurity, which might be a surprise to anybody who's been watching how that some of that sector has sold off recently. But to me, near term, that's where the opportunities really are.
And within that group, what names specifically do you like, Malcolm? I know that you favor Palo Alto Networks. Why is that? What is it specifically about Palo Alto that you like?
Yeah, so Palo Alto, I've been wanting to buy for quite some time. I, as an investor, love to buy into weakness, obviously, and never want to buy into strength. And that's a name that's been running pretty strong, right? Up 50+% for the year, even with this most recent pullback. And so really what's bringing that one to the top of my watch list now is that it got sold off recently as, I think, sort of a knee-jerk reaction by analysts who were spooked a little bit by Microsoft saying that they're breaking into Palo Alto's bread and butter end-to-end network. But I actually think Palo Alto is a great place to be on this little bit of a pullback. 13-14% I think it's been just in August so far, which created a great buying opportunity because we're not going to see cyber threats decrease anytime soon. We're not going to see hackers no longer interested in hacking crypto exchanges and stealing Bitcoin, for example. And so to me, the place to park some capital that's looking for an opportunity where the markets may be pulling back, it's a place where there's going to continue to be demand regardless of what the market cycle actually is. And so I'm currently personally an owner of CrowdStrike. Palo Alto, to me, kind of bookends that so that you get some of the government contracting opportunity, plus a lot of the enterprise in the private sector. So those two together, to me, or just buying CIBR, right, the First Trust cybersecurity ETF, either one of those, to me, is a great place to start to buy as the market does eventually pull back.
Malcolm, great insights. Thank you very much indeed for that. We will pursue the conversation with you later on in the program. Malcolm Ethridge stays with us. We're going to take a quick break on the program. As we tail out, let's take a look at shares of Ford and General Motors, both sinking overnight after the July CPI report showed prices for new and used cars are finally cooling. We're back in 2 minutes. Good old Rick, thank you. Let's get back to Malcolm Ethridge from CIC Wealth. Malcolm, let's just continue stress testing this momentum rally. Earnings, they've dodged the bullet so far off this significant rate shock, as has the consumer. But is this resiliency on borrowed time? And all of this, of course, is a function of where we are in terms of the lag effect of these rate hikes and the impact of tighter credit conditions. Your thoughts?
Yeah, I would argue, yes, borrowed time is a great way to say it. I think I've been saying for some time that Q2 earnings season is probably the last good earnings season we're going to get through 2023. And so far, what we've seen from the markets, the reaction from the markets to earnings has pretty much proved that thesis. We've had really solid earnings out of some companies where CEOs just gave less than stellar guidance for the rest of the year. And the market has responded by selling off their shares even after they beat expectations for the quarter. And so it just says to me that the market is has expectations and is looking for something that the economy is not necessarily delivering right now. And I think a big piece of that, what's really missing, is the fact that the consumer is running out of firepower. I think that we keep getting these reports from JP Morgan and Bank of America, for example, that tell us that the deposits on hand are still strong and sufficient, but credit card balances are also at an all-time high. And so there's a real disconnect there that tells me that really what's happening is consumers' ability to continue to take price, regardless of whether they want to keep spending or not. They just don't have the capacity to keep on spending at all costs, which means companies are not able to just pass along their costs to the end consumer the way that they have been the last couple of years. And that's what's starting to come to a head in these earnings conversations as we guide for Q3 and Q4.
So does that imply then that the soft landing crowd are ultimately going to be proven wrong?
Well, I think the soft landing crowd is going to ultimately be proven wrong, whether it's for that reason or another, specifically because I think we should be paying more attention to the yield curve, right? If we just consider the fact that the twos have been inverted above the tens for more than a year now, And every single time that has happened since 1955, I think is our marker, we have had a recession that followed. I think it's 10 times it's happened since 1955. And every single time we have had a recession that followed. And I know sometimes the perma bulls want to make the argument that this time is different. It's not a reliable indicator anymore. And I would just point to the fact that, in 2006, we had the exact same thing happen. The market was, the yield curve was inverted for 22 whole months. January 2006 is where it first started. It ran 22 whole months, and then finally it happened. And we all know how that worked out. But you had folks like Alan Greenspan and Ben Bernanke at the time saying, this one is a blip, nothing to see here, don't worry too much about it. And so for my money, that indicator is as rock solid as it can get. And so I am concerned here watching the yield curve and saying, when is that shoe going to drop? Because a soft landing just does not seem possible to me.
Isn't there an element of truth of what those perma bulls say, though, given the fact that there are a lot of technical distortions in the bond market at present, given the Treasury supply, for instance, and the new issuance?
Sure, but I would make the opposite argument, the fact that the Fed has raised short-term interest rates 500 basis points in a year, and we haven't seen that aggressive hiking happen in forever, right? And so Jerome Powell's mandate, at least in his mind, is to continue tightening until something finally breaks. And I think he's made it clear to us that he is very willing to continue hiking until something breaks. And that something breaking probably means that a recession hits the shores here. And so I would just say, just because it hasn't happened yet does not mean that it's not possible and not plausible.
Yeah, I've probably been watching so many movies, right? But I liken what the Fed's been doing. There's actually 525 basis points, right? This campaign, probably the most aggressive we've seen in modern history, right? I liken it to, let's say, getting beat by a phone book or with a rubber hose. You don't see it on the outside, but inside you are hurting. So, Mel, this no soft landing, you're not buying that consensus view right now. In fact, it's actually shifted. It's gotten more optimistic. Some folks are talking about no landing at all. The economy is just going to cruise on by. You're not buying that. So what are you telling your clients? I mean, how are you advising or recommending they play defense?
Yeah, so it's two separate things at the same time, right? So on one hand, you have folks that probably are a little bit higher indexed to stocks than they should be right now, right? There's a piece in the Wall Street Journal not long ago talking about how many seniors were over allocated to stocks and really needed to be dialing it back. I can't remember the exact number, but it was more than 75% of boomers over-indexed into stocks. I think this market cycle that we're in right now, the fact that we're trading sideways and the market was up 20% once upon a time, now we're 17% on the S&P, it's creating a really attractive off-ramp for anybody who should have been getting off this highway long ago and reallocating their portfolio to make sure that it actually matches where they should be right now. It gives that opportunity to do that and doesn't penalize you for being a little bit late to do so. So I think for anybody who's, say a pre-retiree or currently in retirement and actually needs to be living off of that portfolio, the market is giving you a second chance. But for those who are a little bit more long-term oriented, I think you just prepare to ride the wave. One place that I think is a good option to look at, we've been buying more brokered CDs the last, 6 months maybe, than at any other point in my career. And so I think that's an attractive option. If I can get paid 5+% to wait it out for a 6-month CD, why not just, wait and see what the market has for me rather than taking that dry powder to the market today at these highs, at that multiple that we just talked about, and finding out soon that this was actually the peak for this particular cycle.
Indeed, I hear you. You're 5%. You're talking about money market here, and 6 months out, that's very little. Still a lot of flexibility, not that much reinvestment risk. Doesn't sound like. Mel, we got to go. Great to talk to you. Appreciate the time. You keep safe and try and keep cool. We'll talk to you again very soon. I hope. Malcolm Ethridge there from CIC Wealth joining us live. We'll take a quick break. Squawk is back in 2.